For decades, Wall Street has operated in a very predictable way. Markets open. Markets close. Trades take time to settle. And access is limited by geography, schedules, and intermediaries. Most people accepted this system because it was the only one that existed. But recently, something started to change. Major financial institutions began talking seriously about tokenization. Not as a trend. Not as an experiment. But as real financial infrastructure. So the first question most people ask is simple. What does tokenization actually mean? Tokenization is the process of turning real-world financial assets into digital tokens on a blockchain. Stocks, bonds, funds, and even real estate. Each token represents ownership. That ownership is recorded digitally, and it can be transferred almost instantly. The asset itself does not disappear. It remains real, regulated, and backed by legal rights. What changes is how the asset moves through the system. Instead of passing through multiple banks, clearing houses, and settlement layers, it moves through code. That leads to another important question. Why would Wall Street want this? Traditional financial markets are slow. A stock trade can take days to fully settle. Markets close on weekends. Cross-border transactions are expensive and inefficient. Tokenized assets remove many of these limitations. They can trade 24 hours a day, 7 days a week, with faster settlement and lower operational costs. For Wall Street, this is not about ideology. It is about efficiency. Systems that move faster, cost less, and scale globally, are difficult to ignore. Another question people often ask is this. Is tokenization the same as cryptocurrency? The answer is no. Cryptocurrencies like Bitcoin are native digital assets. They exist outside the traditional financial system. Tokenized assets are different. They are traditional financial products, built on modern technology. A tokenized stock is still a stock. A tokenized bond is still a bond. The blockchain simply becomes the infrastructure that records ownership and transfers. This is why regulation matters. In the United States, companies are actively working with regulators to tokenize assets, within existing legal frameworks. This is not happening quietly. And it is not happening illegally. Which brings up another concern. Is this system safe? Tokenization does not eliminate risk. Markets will always involve risk. But it does introduce transparency. Every transaction is recorded. Every transfer is traceable. And rules are enforced by code. That does not make markets perfect. But it makes manipulation harder to hide. Another common question is about access. Who benefits from this system? Tokenization allows assets to be divided into smaller units. This enables fractional ownership. Instead of needing large amounts of capital, investors can access smaller portions of assets. In theory, this lowers barriers to entry. In practice, how much access improves will depend on regulation, platform design, and policy decisions. And that leads to the biggest question of all. What does this mean for the future of finance? If tokenization continues to grow, financial markets could change at a structural level. Markets that never sleep, settlement that happens in seconds, and global access with less friction. Traditional finance and blockchain-based systems may not compete. They may merge. Not overnight. Not without resistance. But gradually. Tokenization is not a revolution. It is an evolution. A change happening beneath the surface of the financial system. Most people will not notice it at first. But once the infrastructure changes, everything built on top of it changes as well. That is why Wall Street is paying attention. Not because it is hype. Not because it is fashionable. But because systems that are faster, more efficient, and more adaptable, tend to replace the ones that are not. Whether tokenized assets become dominant or not, one thing is clear. The financial system is being rewritten. Quietly, incrementally, and in real time.